Welcome to the Broken Pie Chart Podcast, episode 330. I'm your host, Derek Moore. All right, I had a question this week, and it was really someone had said, is the 60-40 portfolio dead? All right, this is kind of an old argument. I've covered this before, but I want to go at it a different way. And the question really was, why would you want bonds? Or really it dealt more with, would you rather just buy the S&P 500 or large cap US equities and be hedged, or have a 60-40 portfolio? And I think it gets to, this is a little bit of portfolio construction and thinking about when you're running calculators and you're running different software, you are using historical returns to try and make a projection. And one of the things I think it's important to point out is when you are running projections, and anytime you look at historicals, of course, you have no idea if that's going to be the same going forward. But what does Mark Twain say? History doesn't always repeat itself, but it often rhymes. But specifically to bonds and thinking about the 40% in the portfolio, remember, if you are doing a 60-40, a 70-30, an 80-20, a 50-50, whatever it is, you are essentially saying that I'm going to sell 40%, let's use the 60-40, 40% of my allocation to equities, i.e. stocks, i.e. the S&P 500, for example. And instead, I'm going to choose to go into, let's use the 10-year treasury as a proxy here. You can use the AGG, you can use a number of things, but let's use the 10-year treasury. And you're saying, I'm going to sell stocks and I'm going to go into bonds. And why is that sort of a consideration of 60-40 versus maybe a hedged equity portfolio? Well, we know that over time, stocks generally have provided a higher return. Now, understandably, equities have more volatility. But I think this kind of brings up the point of, imagine you could just not look at your portfolio. Let's say you started as somebody who's young and you put more money into the stock market, or you put money into the stock market and you went point to point. And you said you never looked at it. You never knew that it was down, it was up, it was down, it was up. And let's assume you have that same amount of money. We're not adding money. We're not taking money out. That's a different thing. And you just looked at your returns and you would say, well, I would have been theoretically better in equities. Okay. If you had watched it, though, the idea is that you would have had more volatility, more standard deviation than, let's say, a bond and stock portfolio. So a lot of times the reason someone goes into bonds is to dampen the volatility, meaning the standard deviation of returns is less. You look at risk-adjusted returns. You look at a number of different things. The challenge, though, in using, let's say, historicals when it comes to bonds is 1982, 1981, inflation was really big coming out of the late 70s. You actually could have bought bonds with yields, 30-year treasury bonds, even probably 15 to 17%. I should have brought it up because I do have that chart somewhere. So what I did was I looked at and I said, well, what's the average return? And the average isn't necessarily the best way to do it. It's really compounded growth rate is the better way to do it. That's what an investor would actually experience. But I just used this as a good proxy. And I said, well, the 10-year treasury since 1980 through 2020. And why 1980? Because basically, I could have done it since 82, I guess, or 81. By the way, 1982, the 10-year treasury bond was up 32.81%. That's when interest rates started to go down. Inflation was broke. 1981 was 8.2%, 1980 minus 2.99%. And so you look at this and you say the average annual return, the simple average from 1980 through 2020 was 7.93%, nearly 8% for 10-year treasury bonds. So think about that. If you're plugging that into some calculator and you are saying, well, I'm going to do a 60-40 portfolio and look at these average annual returns, there's been a 40-year plus bull market. Basically 40 years of a bull market in in treasury bills, or treasury bonds. And here we're using the 10-year treasury. And what do I mean by that? It means for 40 years, we've had basically a downtrending chart of yields. And as yields go down, bond prices go up. So if you're continuously investing in a 10-year treasury, refreshing it every year, that's about the average annual return. Now, a little bit of cherry picking here. Since 2020, the average, the simple average, is minus 5%. Does that mean you're going to get minus 5% going forward? No, I'm not saying that. In fact, I think the CFA, somebody at the CFA Institute put out a paper. I can't seem to find it, or I would link to it. And the paper had basically the idea that over a 10-year period, your average annual return should pretty much be whatever the coupon was, or the yield to maturity was, when you actually invested in the bond. And it's not necessarily that they would hold it to maturity. It's just they did some research there, and more or less over the long term, whatever the starting yield to maturity is around what you wind up with. Don't know what that's going to be going forward. So the point of this is, when people ask me, is a 60-40 portfolio still a good idea? The last thing I'm going to do is give individual personalized advice over the air to everybody. But what I would say is that the 40%, remember, you have to sell something in a portfolio to create space, real estate in your portfolio to invest into that 40%. And is it likely that over the next 10, 20, 30, 40 years, let's say, is it likely that we're going to see a reduction in interest rates similar to what we had in that 40-year bull market in bonds? Bull market meaning bonds go up, yields go down. And look, I mean, the starting yield today is what, 4.2-ish percent, 4.3-ish percent on the 10-year? It's not 17. It's not 15. It's not 13. So in my opinion, and it really depends on the individual, but I like the idea of owning more of what you sort of want to own, but hedging the downside. And what does that mean? That means you're not going to probably get all of the return, because you're going to give up something. There's the cost of hedging. There is the amount of the portfolio that you're not investing in, let's say the S&P 500. So you have 100% sleeve, and you say, well, maybe take about 3% for the cost of hedging, and I'm investing about 97% in the S&P. But could you try and get a good majority of the upside and then really dampen, if you have very bad years, protect on the downside? And I would say there's a compelling reason that hedged equity, given where we are in the cycle for bonds, and given that it's unlikely that we have a 40-year bull market in bonds going forward based upon the starting yield, I think it's kind of compelling compared to a 60-40 portfolio. Does that mean we don't use bonds? No, we use bonds in some of the portfolios. We use a lot of short duration stuff, both high yield, and we use that as a funding source for some of the strategies. So why do I point out that the idea that, remember, you are carving out, you're taking real estate in the portfolio if you are doing a 60-40? Well, the reason I say that is, over time, and if you look at, it's not on our website anymore, but I did the returns decade by decade. And if you look, I mean, 2010s, something like, it was over 13% average annual return. 2000s, it was like negative 1% average annualized return, meaning looking at the entire decade and then annualizing returns. 2020s, it's over 13% again. And then you go back to the 90s, the 80s, plus 16, 17% in those years. So really, the only decades that have had negative annualized returns going back to, I think, the 1910s is the 1930s and the tech crash, the 2000s, 9/11, the 3-year bear market. I mean, 2000, 2001, 2002, 3 years in a row, the S&P was down. And then, of course, we had 2008. So all of that happened in that decade. So anyway, uh, that's sort of a quick response to that. Again, it's not individualized advice. Everybody's different. But I'm just saying, is it likely that you're going to have that type of period going forward like we had from 1980 or 82 to 2020? I'd be hard pressed to say that. It could happen, but I think yields would have to go negative on the 10-year and maybe a little bit more negative even to not- more than a little negative, I think, to get some of those returns that we saw. I mean, I'm looking at 82, 32.81% on a 10-year treasury, 85, 25.71, 86, 24.28. I mean, these are returns that um, just, I mean, they're equity-like returns. They're NASDAQ-like returns. 2008, up 20%. Yields dropped. Certainly, they did their job. 2022, which was a downturn in equities, and simultaneously where bonds didn't offer anti-correlation, they didn't offer an offset. 10-year treasury down 17.83. Of course, the 30-year is down more than that because the longer the duration to maturity, and there's a formula called the effective duration, modified duration, Macaulay duration, pick the one you want, but it's how much will a bond go up or down based upon a 1% change in interest rates. So the longer the duration, the more sensitivity to rates. It could help you if rates are really dropping. It could hurt you if rates are going up. So just something that came up on the when I get questions. You can send those to me at derek.moore@zegetinvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. Send emails. We like getting emails. We'll bring them up on the show. All right. Randomly, I saw this on Twitter. JC Peretz had tweeted something. Looks like this is a graph. Is this Charlie Balalo? Yep, looks like it is. And what he did was, well, I'll read the content of it. And JC Peretz says, quote, "They're not bad people." So basically this is showing, what if you invested in the S&P 500 every time CNBC had a markets in turmoil special? It's kind of similar to what I call the cupcake indicator. You know, when you're watching the local news and they're making cupcakes and they suddenly decide they're going to put a superimposed chart in the bottom right of like the Dow Jones. And it's always the Dow Jones, not the S&P, which we all look at. But quote, "They're not bad people. They just have much different objectives than we do as traders and investors. We're in the business of trying to make money. The media is only in the business of distracting the people who are trying to make money. A key difference few seem to understand." And basically, you know, when you look at this, so the day the market's in turmoil, I don't know how they compiled this. This is actually impressive. I don't know how they did this, but it's going back to, let's see, 2010, and it has the day the market's in turmoil special ran. You know, when they stay on later and they have the markets in turmoil and everything's red in the graphics, and they bring a bunch of people on who are pontificating about it's only going to get worse and all this. So the average 1-year return post this since 2010, since average 1-year return is 40%, plus 40%. The percent positive 1-year returns 100% of the time. I mean, who knows if this continues to work. The last markets in turmoil special, they have 5/5 of 2022. Let's see. Wouldn't they have run? I'm not sure how they did the dates. Wouldn't they have run it near the lows? I'd have to look at this. But anyway, and it's question marks. So, for example, they ran a markets in turmoil. Let's see. Last one, 6/4 of 2020. And the 1-year forward was 38%. The first one, they ran a lot of them that year. Oh, wow. I mean, I can't even tell you how many of these. They started on 3, let's see. Okay, most of these are 2020. I might throw a flag on this because your sample size is basically 2020, 2019. There were two of them in August of 2019. There were some 2018s, 2015, 2011. All right, here's the thing. Like, this list is pretty long, but it's got multiple ones. I think the sample size is a little low. But the point is, like, if you see my cupcake indicator or you see the markets in turmoil, I think it's a contrarian indicator, and we know that there's plenty of contrarian indicators. But yeah, I mean, I wish I could find it. Somebody had put together a chart of the performance of the S&P. They had a chart of the S&P, and they had a chart of the ratings for CNBC. And basically, it was an inverse. Like, the lower the market, the higher the ratings. So, like, CNBC really likes markets in turmoil because they get more eyeballs. Like, all of a sudden, everyone starts looking at it. So, I don't know. I think the point is, markets in turmoil, good contrarian indicator. Sample size. I mean, there's so many of these from 2020. All right. I want to talk about the Fed. And all right, I'm just going to say I'm kind of tired of hearing about the Fed. They did the meeting. They didn't do anything. They talked about it. Somebody said, I think it was on Friday or Thursday, maybe we'll lower the rate at the July meeting. And then, Powell at the press conference, people liked what he said. People didn't like what he said. I'm sort of tired of it. And the reason why I'm tired of it, aside from housing, but I'm sort of tired of it because just because the rates are 4.33 effective Fed funds rate doesn't mean that the market can't do okay. Rates are not high from a historical perspective. They just aren't. I'm sorry. We had rates 4 to 5% in the 1990s. It was fine. Markets did okay. Like, you don't necessarily want the Fed to have to lower rates, because if they're lowering rates, there's some issue. Like, I don't know why they would necessarily lower the rate just because inflation is trending down. I mean, the 2-year yield is basically saying that the Fed's offsides here, that they have rates too high. The bond market doesn't believe it. But I'm sort of tired of it. Here's why. Jay and we talked about this several years ago. And everyone said, remember when we had inflation, that the Fed was asleep at the wheel. They're the reason why there was inflation. No, it wasn't. I don't believe that. I mean, the Fed, think about this. Rates were essentially zero for like a decade, and we didn't have inflation. And I know it's, always everywhere a monetary, with the Friedman quote, slipping my mind right now. But you look at 2021, 2022, 2020, all that stuff. Like, I think the Fed could have kept rates exactly where they were. We'll get to housing in a second. They could have kept rates exactly where they were, and inflation would have had the same path as it did. Them keeping rates low didn't cause inflation. Like, why would it cause inflation in 21, 22, and 22, let's say, when it didn't cause inflation for over a decade, 2008, 2009, all the way through, let's say, 2020. Rates, 2020, the short end of the curve was basically nothing. Well, actually, that's not true. So was it 17, 8? I guess in 18, they started to raise them or try and normalize rates. And my market didn't like that. But my point is, like, the reason we had inflation, and I think everyone was looking at the demand side and thinking that if you raise rates, you tamp demand, or if you keep rates too low, you increase demand. And the reality is, we sent people a bunch of checks, and people took those checks and they bought goods. And the goods had to come over from overseas, a lot from China. And we had a supply problem with the amount of shipping. And remember the lines at the ports and container rates going up to $10,000. They're now like 1,500 or 1,600. It was a supply issue. And if inflation is a supply issue, kind of the worst thing that you can do is just throw money at it. Demand is a different one. And I think people sometimes, they're so used to the demand side being the issue. Supply side is, go back to the oil embargo and the price of oil in the 70s. It's kind of a supply thing. So the way I look at it, I think the Fed just could have done nothing. They could have done nothing. And inflation would have had the same path. We get to housing though. And I would say that there is an imbalance between sellers and buyers, and there's probably an imbalance between where people want to sell their house and where people are willing to buy it. And we also have this dichotomy of there's a lot of people who have no mortgage. I mean, their house is either paid for or they bought it in cash. I think I've seen some figures, 35 to 40% of houses in the US don't even have a mortgage. I don't know where I saw that. Of course, it's true if you read it on the internet. And then you have this cohort that has mortgages in with either a 2 handle or a 3 handle, a 4 handle, meaning like 4 point something percent. That's what I mean by the handle. And then, 5, 6, 7, 8%. But there's still a lot of people who have low mortgages or no mortgage. And those that can sell a house, maybe they have a lot of equity in it, they don't have a mortgage, and they want to downsize. I mean, they can take that cash and then go buy something else and not have to worry about a mortgage. But if rates are higher, the same priced home at a lower rate versus rates now, it is more expensive on a monthly basis when you look at a mortgage. So if the Fed wants to try and unlock housing, they should probably lower rates. But here's the other angle on this, and I've talked about this many times. The spread between, let's say, the 30-year mortgage and the 10-year treasury yield is historically right around 170 basis points, meaning if the 10-year is 4, you'd expect the 30-year on average to be around 570. That spread has widened. It's been hovering around 300 basis points, at 3% to the 10-year. Certainly in the twos, sometimes 2.5 or high twos. And part of the reason why I think there's that increased spread is just think about the mortgage bond market. I mean, if you're issuing mortgage bonds, or let's say you're the holder of a mortgage bond, and I mean, coming into, let's think of the last couple of years, like the thought has been the Fed's going to lower rates. And so what happens if somebody has a mortgage and the Fed lowers rates and the 10-year drops? Well, mortgage rates go down. And what do? They're going to refinance. And so if you're buying mortgage bonds and then all those mortgages in there are going to get refinanced, quote unquote, in theory, then basically you're not going to get to enjoy the higher interest rate. And so I think that's part of why mortgage-backed securities now, the spread between the 10-year and the 30-year mortgage, for example, is wider. So that could come in, and that would certainly provide relief. But, I mean, the Fed could also lower interest rates. I don't think, does it really matter if they lower them a quarter point or a half point? I don't know. I'm starting to tire about all this focus on the Fed and what a quarter point or a half point would do. And of course, people in government are going to be lobbying for lower rates because the interest on the debt. And we know it doesn't matter who the administration is, we run a deficit, and it's cheaper to finance the deficit the lower the rates are. But anyway, I'm tiring of the Fed discussion. Lower rates, keep them the way they are. I mean, so far equities have been okay with higher rates. And when I say higher rates, I'm almost smiling because anyone who's older remembers the 1980s. We were just talking about the 10-year treasury, how well it did as rates came down. So enough of the Fed talk. They'll either do it or they won't. And I also think that this dichotomy of the administration publicly talking about Powell, and Powell kind of thinking, maybe he'll keep it. But I think the real disconnect has been the idea that the Fed believes that tariffs are going to they're going to have an effect, and then we just haven't seen it yet. They're going to cause inflation. We talked about it last week, how some people think inflation is going to be 10% over the next year. Other people don't think it's going to be that high. We do know that I saw some data. It looks like this is from the Treasury Department. And, in May, they took in a record amount of customs duties. These are from Charlie Bolello on Twitter. $22 billion in customs duties in May 2025, which is 4 times higher than the same month in 2024. But so far, we haven't seen tariffs cause inflation. Inflation's still trending in the right direction, meaning lower. We just haven't seen it. And so, does the Fed need to wait until inflation gets down 2%? I don't know. I don't think it really matters much. Do I think rates should be where they are? Looking at the 2-year, you could make the argument that probably they should be more like 3%. It would certainly help housing. And housing in this one area where things are, it's just, you have people with mortgages, you have people without mortgages, you have people with cheap mortgages, you have people with expensive mortgages. The good news for people who have a mortgage at a yield that's higher, like right now, is that essentially you have a callable bond. You can go and refinance that mortgage. You'll pay money to do it. And here's a little pro tip. If you're paying points right now, let's say you pay points to buy the rate down. And you might say, well, I'll do that because I will lower my payment. Now, when you pay points, you're essentially prepaying the interest. But here's the thing. If your intention is you're saying, I'm going to be in this mortgage, but then if I get an opportunity to refinance, I'm going to refinance. But if you paid down the points, if you pay down money to for points to lower the rate, you don't get to carry that reduction with you. You do a new mortgage, that's sort of money out the window there. So anyway, that's a little pro tip. Really think about whether or not you want to pay points or not. All right, what else we got going on? I'm going to have to title the episode something with the word contrarian in it. Something else I saw that piqued my interest was Mike Sakari had tweeted out a Bank of America, U.S. equity and quant strategy and Bloomberg chart from B of A Research. And it was short interest has risen in 2025 year to date. Short interest versus float ratio for total U.S. market 2008 through April of 2025. Why is this contrarian indicator? Well, so short interest looks at the float. So how many shares are actually, part of the public float, tradable, all that stuff. I won't bore you with the details of how you look at a float, but it's the shares available. And then the short interest means what is the percentage of shares? And looks like this is total U.S. market. What percentage of the shares are currently held as shorts, meaning somebody's betting against the market? And it's the highest it's been since, I'd say, 2020, not as high as 2016, but actually on par with, I don't know, right around the 2009 period. Maybe that was a little bit higher. So why is this contrarian? Well, the reason it is, I think it's sort of institutional investors, it seems like, are more bearish than retail investors. Retail investors are like individuals, where institutions is investment banks or large money managers, that type of stuff. And you could see this in their deployment of cash. Like, are they in cash instead of being invested? Or are they actually putting money to work and they are shorting things? So the reason this is contrarian is that if someone is short, they have unlimited loss to the upside, meaning you short something, you're betting against it. You make money if the price goes down because you sell it short and you hope to buy it back cheaper later. Well, the inverse is if the stock goes up and goes to infinity, and by the way, I've never bought a stock that went to infinity. I'm still trying. But you short it And if you have to buy it back higher, you're losing money. Well, you have unlimited loss, and you also get into some of the margin rules and things like that in the accounts. But short covering, so if a position moves against a short seller, they may be forced to buy back in that short as things are moving higher. So not only have the buyers, more buyers than sellers, pushing the price of an asset higher, you have short sellers buying to cover their shorts, adding to the buying pressure. And it's called a short squeeze. Now, it's right around 4.2%. So it's sort of relative. This is the total US market. But I think it does reflect some of the innate bearishness that's still there among the institutional side. And individuals, I mean, short interest to really move like this has to be institutions. Individuals don't have enough capital to move the needle on this. So it's one of those things where I think I'm still seeing and just talking to people, and it depends which side of the aisle people are on, but there's some people who just want to be in cash, think the market's going to zero. Other people think it's okay. And I always tell people, I mean, over time, it really doesn't matter who's in the White House, who is running Congress. I talked about those. I did the analysis on all that a number of times. But it just speaks to if we do get a breakout here, and if we get a breakout to new highs, typically what happens is people who have missed it are forced to come into the market. And if people are short, they might have to cover their shorts. Look, I don't know what's going to happen, but it does seem like there's still a degree of bearishness. This has been a hated recovery. I'll put it to you that way. Last couple things of note: gold still working. So far, year to date, I think it's over 27% now, up year to date. Last year was a very strong year. That's been working. The U.S. dollar, remember I talked about it as a very crowded short or bearish position. It's gone down lower. Keep an eye on that around earnings season, because typically that could help bolster revenue or sales and earnings, all else equal. If they're big multinational companies that are selling things overseas, as they repatriate those local sales back to U.S. dollars, because U.S. companies report in U.S. dollars, that could actually help increase their sales and earnings, all else equal. And the reason why I say that is that assumes everything else is equal, meaning there's same sales, same all that stuff. The other thing is, and I talked about this last week as well, crude oil or West Texas Intermediate oil, after running up, has, it sort of ran up, made a high, and then made a high right around $75, $75.14 a barrel, and then it's come back down. And I mentioned that it really just ran up into the middle of the range. It had broken out below that range, and then it's run up into the middle of the range. So I don't know. I mean, sometimes I just look at this, and I swear people have asked who don't normally invest, and one of my neighbors, I was walking my dog and talking to him, and he said, "So, how would I buy? Oil's gonna spike. I think oil's gonna be a good buy." And it's somebody who doesn't really invest. And I said, "Do you want to buy crude oil futures, or do you want to buy?" So anyway, it just you sort of see stuff like that, and I don't know. I mean, the U.S. definitely has more oil production now. Canada has more oil production than certainly in the late 70s. But sometimes the most obvious things, I mean, it might work. Maybe someone who doesn't invest and suddenly decides to get a hunger for crude oil futures. Don't do that, by the way. There's a lot of leverage there. Maybe it will work, but so far we've seen it kind of spike, roll over a little bit, stay steady, really just rally back into the range. So I don't know. We'll see. All right. Next week, my plan is to have a co-host. More on that next week. And watch the Stanley Cup Finals. Game 6, Florida did it. Really good team. Are they a dynasty? I mean, they won the President's Cup. That means, for those of you who don't know what that is, they had the best record in the league. Got ousted in the first round of the playoffs. Made some trades. Started to bring people in. Went to the Stanley Cup Finals, lost. Went to Stanley Cup Finals, won, and then won this year as well. So over the last 4 years, they've been a really good team. So unfortunately for our Canadian listeners, it's your long national nightmare continues. And I think it was 93 was the last year. Was it Montreal won in 93? So a Canadian team has not won the Stanley Cup in quite some time. But it was great though watching Connor McDavid. I mean, he's so much faster than everybody else. He's clearly the best player on the ice, but Florida's tough. So now that that's over, I'll get back to my viewing and watching. I have a pre-recommendation though. So I plan on going seeing the F1 movie with Brad Pitt next. I think next week it comes out. I forget when we're going, but we're gonna go see that. I think it's supposed to be good. And I watch F1. I started watching You Have to Drive to Survive. If you haven't seen Drive to Survive, I mean, I don't know how many seasons there are now, like 5, 6 seasons. Watch that. Start to watch the races. I'm more interested in the strategy, like when you change your tires, when you pit, when you sort of go on the different types of tires, how many pit stops, all that stuff. That's really interesting to me. I know certain drivers are really good at passing people and driving, but I understand the strategy side a little bit more. So, but I think that movie's going to be pretty good. I think it's the same people who made Top Gun, so I have high hopes for that, and I'll report back once I see that. I don't know if we'll record by the time I've seen that. It might be the 2 podcasts from now. And send emails. We like emails. All right. See you, everyone. Take care. Bye.